right. Good morning, everybody. This is Barry Wilkin, and with Agents Insurance, and I appreciate everyone's time here this morning. I want to introduce to you John Marques, who's the president and chairman of Lifeline Innovations. And John and I have worked together for some 30 years, and he's one of our partners in arms in the advanced marketplace. So many of you that are on the conference call and the webinar today are in the med supplement world, and we want to talk to you about how you can cross-sell into this marketplace with some of the alternative investment programs out there. And then some of you here are in the annuity world, and some of you in the life world, and we want to open up the doors to this market to you. Today in the investment world, people are looking for other alternatives. Sometimes, as you all know, when you're out seeing your client, they may tell you they've got all the annuities want. Maybe they're heavy in the securities world and they don't want to get into any more securities, even though the securities business right now is growing and interest rates climbing and climbing. The bubble is kind of overheated, to be honest with you. I'm surprised that it hasn't kind of changed in the last year or so. But the advantage to this program here is it gives your clients another alternative. So if you have questions, please, when we're done with this, you can give us a call. We're here to help you create leads, to create business. If you are life and annuity salespeople, we have started a new division in the Med Supp and Med Advantage world, and Lee Jordan runs that for us. And I think Lee's on this call today too, but Lee will be more than happy to get you into that Med Supp world. The whole advantage, guys, is you have to build a client base. And by building a client base, a lot of times that means selling 2, 3, 4, 5 products. John Marques is just a premier producer, an outstanding individual, and he is one that knows how to build the clientele. So at this point, I'm going to turn this over to John. And please, again, at the end of the meeting, if you have any questions, you can give us a call or drop us a line, and we'll be glad to help you. John, it's all yours.
Thank you, Barry. Really appreciate it. First of all, I just want to introduce myself. My name is John Marques, and I've been in the financial services industry. This is my 33rd year. I've known Barry for almost 30 of those 33 years, and really have enjoyed working with him, a first-class organization with Agents Insurance and Sales. And we're very excited about our affiliation. Today, we're going to talk to you about something that's really exciting. It's been 7 years in development for us, and we're actually just taking off like nobody's business. I'm located in the San Francisco Bay Area. My primary market is Silicon Valley, and my primary market base is 55 to 70. And we're picking up a ton of clients using a strategy I call permission marketing. And in permission marketing, what we do is first thing that's important, you can't really market to somebody that you don't know. I mean, that's where we start. Everybody has to start someplace. And in the permission marketing world, basically, if I can get a client to buy a product from us, after they buy that product, we can be in a situation to market to them. That's why I call it permission marketing. If you're my client, I can send you whatever I want to send you on financial services over and over again. And so we get a client, and then we do a multitude of programs to our clients and try to make them more tax efficient, and also create an energy level that I've never seen in my 33 years. So kind of go through this now, we'll get started. So what we're going to cover today is we're going to show you an opportunity that I believe is one of the greatest opportunities that I've seen since I've entered the insurance business in the last 33 years, and capture that unrecognized opportunity in our industry. Very few agents know about it. Very few agents sell to this market. Very few agents have the opportunity, and we call this the alternative investment revolution. And we'll explain how to use alternative strategies other than annuities to create income streams, and how to create annual residual commissions for all of you. Now, for those of you that are on the line that are Medicare supplement agents, One of my agents is one of the top Medicare agents in all of the state of California, and I can understand, working with her, I understand what the Medicare supplement industry is like. You go out and build a book of business, and you get residual income, and you continue to build that book of business. But as anything in life, there are challenges, regulatory challenges, sales challenges, and then price increase challenges in that industry. So if you believe in residual income, you're going to love the alternative investment industry, because there's tremendous residual income opportunities. The only problem is finding the clients, which has always been, the marketing of it. So our executive board, obviously, Barry Wilkins. There's a picture of myself. I'm the CEO, president of Lifeline Innovations Insurance Solutions. And I also believe my partner, Greg Talbot, vice president of Lifeline Innovations, is on the line also. So the industry dilemma, as I look at it, you have life insurance agents and annuity agents. Annuity agents don't like to sell life insurance. Life insurance agents don't like to sell annuities. They're kind of a different world. In the life insurance industry, there's a lot of order taking going on. How much coverage do you want? How much is it going to cost? And then there's obviously the annuity side, but the annuity side, you got to really know a little bit about qualified and non-qualified plans, and a little bit about investing. So usually there's great life insurance agents who don't sell annuities, and there's great annuity agents who don't sell life insurance. Over here on this side, we have the Medicare agent. They're even more removed, because most Medicare agents don't sell life insurance and don't sell annuities. In the Medicare side, I consider this an order-taking business also, depending if you have leads, because once somebody turns 65, Medicare supplements are important. So essentially, Medicare agents aren't selling life insurance and annuities. Life insurance agents aren't selling Medicare. Annuity agents aren't selling Medicare. And there's three different industries kind of tripping all over themselves. But yet personal income in this industry is down 47% as of 2016. And so, prospecting, how do you sell? Prospecting, traditionally selling, there's lead programs, there's networking and referrals. But now, what I've been working on is the alternative investment revolution, which I've been participating in since late 2010 and early 2011. So I've almost 7 years of experience in the alternative investment revolution, and it opens up a totally different world. Not only does it open it up for your clients, but it opens up for you, the agents. So first of all, there's been a major paradigm shift in the way the financial services industry has been going, and it's in the alternative investment. We call it the alternative investment revolution. The major paradigm shift is, over the last 17 years, there's been a paradigm shift for those few investors in the know regarding powerful investment vehicles known as alternative investment strategies. Here's the problem. The major financial institutions, Wall Street, brokers, banks, and insurance agents, have kept these investments essentially a secret from all of you and 99% of all investors. So just like when I do my seminars, I ask, when's the best time to start working out at the gym or to lose weight? You have New Year's resolutions. Everybody has New Year's resolutions. But yet, when's the best time to start something new? Immediately. And one of the things is, I've been kept in the dark over the last 17 years about these alternative investments. And it wasn't until late 2010, early 2011, when Barry and I were introduced to one of the very first alternative investments out there in the marketplace. And it opened up a whole different world. So one of the things that has shown the shift is these what we call endowment funds with some of the largest universities in the United States. You've all heard of Columbia, Harvard, and Yale. And Yale University, if you look at the chart here very closely, you'll notice that in global equities, that stocks, bonds, mutual funds, United States equities, in the equity marketplace, Yale has 18.6% of their money invested in the global equities. And if you go further down on the screen there, you'll see alternatives. They have over 73.7% in the alternative investment strategies market. Now, it's amazing. Over 20 years ago, Yale had over 80% in the global equities market, and only about 15% in the alternative investment market. So what has changed from the late 90s to 2018 or through 2015 in this particular slide? What has changed? Why is it that these endowment funds, which these large university funds, they're all being managed by somebody? Why is it that now 73% of their money is in alternative investment versus 80% that was in the stock market many years ago? Something has changed. There's been a shift in the investment world through the financial services industry, but yet the biggest people in the industry, the banks, Wall Street, are not obviously letting you know about these investments. And if you don't know these investments exist, it's just like you're still using what we call a flip phone. Remember those old flip phones? In a smartphone generation. We're using old technology, yet Wall Street has been obviously not going to sit there and try to tell everybody about these type of places. So it's a new way of thinking. You know, most of the things people talk about these days about thinking outside the box, I came up with an analogy that it's physically impossible to think outside the box if you're standing in the box. So you need to get outside of the box. Not only do you as an agent need to get out of the box and find out how these things work, the consumer is dying to get this information because Wall Street has basically handcuffed them and blindfolded them to all these extra alternative investments that are out there. It's an incredible cross-selling opportunity. The cross-market criteria is it really works well with people between the ages of 60 and 70. Again, I've tested this for the last 7 years, and 60 and 70 is the hot market. If they're under 59 and a half, you have limited resources to get their money out of their current 401ks or IRAs at their jobs. But if they're over 59 and a half, it's literally you can get almost all the money out of the 401k and the IRA if they're even still working to put in to move into annuities or move into alternative investments or move a little bit. Again, one of the things that we do is we don't go after all the money. We simply go after the money that they don't want to have in the market and the money they would like to kind of test these alternative investments out. The most important part of this is to get a client. Once you get a client, you can go back and talk to them about anything. So if they're a Medicare client, within the rules that you've got to abide by in the Medicare field, you can go back and talk to your clients and introduce more programs. If I get them into the office and they want to buy an alternative investment, I sell them an alternative investment. They become a client. After that, I sick my Medicare people on them if they're over 65. I can do IULs. I can do tax planning with them for IULs and tax-free retirement planning. So the cross-market criteria 60 to 70. For you Medicare agents who essentially you're only selling Medicare to people over the age of 65 and over, that's your market there. The net worth of the investor, though, has to be at least $250,000 in California, and can be $250,000 in some of the other states, depending on the rules and regulations on a state-by-state basis. They call it a 250,000 and above client a qualified investor. Accredited investors are $1 million plus. So for you Medicare agents, if you're talking to people that don't have any money, this won't do you a bit of good. But you're going to meet people that are over 65, and depending on what market you're marketing your Medicare products in, they're going to have some assets. So keep in mind that if you have someone with some assets, This would be a great cross-selling opportunity for you. So in the alternative strategy-based planning world, there's several ways to go. All strategies offer terms between, understand very closely here, between 1 and 5 years, whether for income or growth. Now compare that to the typical annuity out there on the marketplace. A typical surrender charge on an annuity is 10 years. That's a typical one. So you make a commission today, and if you put them in a guaranteed income annuity, you're probably never going to get another commission off that individual ever again, unless it's a different product. Annuities are being marketed with heavy concentration by all these marketing firms. And I'm not saying there's anything wrong with an annuity. You're just in a pool of sharks, and there's a lot of blood in the water. You're in there competing with everyone else that has the same product. And again, I'm not saying that that's a bad thing as far as for the consumer. It's just kind of a bad thing for you, the agent, because you've got a tremendous amount of competition fighting for those same dollars. And it is the number one safe product in the industry. It's completely safe and guaranteed. And so we're not saying that you take it out of your planning. You should do the same planning if you're selling annuities, but you need something else to add to it, because just think about the right now, I think the top rated annuity, fixed annuity for 5 years is 3.25%. We can offer our client 8% for 1 year. So we have a strategy that's 1 year for 8%, 2 years for 9%. Is it 100% guaranteed? No. But it has nothing to do with the stock market. They're never going to lose money because of stock market loss. Imagine adding that to the portfolio. You've got annuities. They give them absolutely 100% guarantees in the safe money world. They've got their mutual funds and everything in their world of the stock market and risk. And then they've got what I call alternative strategies, or in my book, we call it blue money. The reason I call it blue money is that it is a security, but you don't have to have a securities license to sell it. It is a security, but there's no stock market risk. And they're high returns for very short term. We got short-term returns between 5 and 9%, short-term double-digit returns for qualified money. So you're talking about 1 year, 2 year, 9 months, 3 years, 4 years. We don't have anything that's over 5 years in the alternative marketplace other than one particular alternative market product that we'll discuss at the very end this morning. So let's talk about, and we're going to just go through this very quickly because there's a lot to learn. And we want to spend time teaching those that would want to get contracted and want to learn how this industry works, and we can work with you on that. But today we're just going to get a peek, give you a quick peek. Strategy 1, land leasing through a company called Resolute Capital, and they have a fund called Petro Rock Fund. These are notes, ladies and gentlemen. A promissory note secured by real property. And for those of you that might not know what this is, this particular fund is secured by 2 UCC1 filings, which allows the investor to be in a first lien position in 2 positions in the same investment. Very difficult for the individual to lose all their money, even if the company fails and files bankruptcy. Very, very difficult for the client to lose all their money. Okay. Been around for about 7 years. Never missed a dividend payment or a monthly payment to their client. They pay 8% for 1 year, 9% for 2 years, 7.5% for 9 months. Now compare this to an annuity, ladies and gentlemen, and liquidity. The problem with annuities is someone who buys an annuity 2 years ago, who has a 10-year surrender charge and has this fantastic buying opportunity, whether the market goes down or wants to invest in these notes, their money is trapped. And they can get maybe 10% out, but their money is trapped to get these short-term returns. They're a secondary market product. And guess what? You're in a blue ocean. There's a book called The Blue Ocean. And there's another book called How to Swim with the Sharks Without Being Eaten Alive. And basically in this formula, you're competing with all the products you're offering with all the other sharks in water that's extremely red and bloody because everyone's eating each other. Meanwhile, I'm traveling, I'm running around in an ocean with no competition. I have zero competition in Silicon Valley, zero. There's people selling these alternative investments, but because of the program I've designed, I have zero competition to work against. Your broker and banker can't offer it to you. And this is just like the technology thing we were talking about, the difference between a flip phone and a smartphone. I'm using smartphone technology in the financial services industry, while the brokers are still doing the same thing they were doing 20 years ago, marketing asset allocation and selling the hell out of annuities down in Silicon Valley. But that's not my competition. My competition is selling stuff that I'm not offering up front. What I'm doing is I'm getting clients. I'm in the client accumulation business. So let's talk about the money. So let's say a typical transaction for us, the minimum investment for that particular note's $50,000. A typical investment's about $100,000. Starting compensations is actually 4.75%. So I just rounded up real quick. But this is starting compensation, 5%. So the comp on this particular program on the 1-year note is $5,000. Here's the good news. I know in the Medicare supplement business, a lot of things have changed. So you go ahead and sell a Medicare supplement, and you get, in the past, you got a pretty good first-year commission, and then the renewals were the same, but then they've kind of cut down the commissions. When I sell this product, which is a bigger ticket item, obviously, but I'm selling something that no one knows exists. So all I have to do is overcome the fact that they've never heard of these investments, give them some information, and those that will buy this. But the average purchase is $100,000, and I get paid $5,000. But just like the Medicare business, the next year when they renew, I get paid $5,000 again. The next year when they renew, I get paid $5,000 again. The next year when they renew, I get paid $5,000 again. So let's just say you did $1 million in sales, which is 10 average transactions, one a month. Not a super big deal. You would get $50,000 in comp, just like in the Medicare business. But in this case, the next year, you get another $50,000 in comp. The next year, $50,000 in comp. Last year, in 4.5 months, we didn't do a tremendous amount of business in 4.5 months, but we did about $3 million in 1-year notes. Now, $3 million is 150 grand, ladies and gentlemen. That means that this year, starting in September, from September till the end of the year, we will get paid $150,000 without doing a sale this year. Builds a little security into your practice. Our goal is to have 10 million in sales by the end of this year for the first year. With a little work, we could possibly surpass that. We got to do it. We did 3 million in 4 months. We think we can do another 7 million to 10 million this year. But if we do 10 million this year, and all we talk to people are about these notes, that is the focus of everyone that I talk to. 10 million in sales, residual income is 250,000. The key to these 1-year notes is you get paid every year, first year compensation. And I won't even tell you about what we get paid on the 2-year note, because the 2-year note, we get paid more than this in the first year, and half of what we get paid more of in the second year. And then in year 3, another first year commission if they keep the notes. Okay, number 2, we got a real estate fund. A lot of Barry's agents have participated in this real estate fund, not subject to market risk. It says double digits returns paid monthly. It's not double digits, it's high single digits, and we'll talk about it. Secondary market program. It's a real estate fund. Started back in 2010, acquiring single family residences. Your broker and banker can't make this offer to you. Right now, in the last 7 years, they've picked up about 440 properties, 95% occupant, cash flow like you can't believe. They've raised about $80 million, and they have equity in these homes of about $200 million. And they have not missed the dividend payment in ever since they started the company. 8% fixed annual rate of return. We just did 130,000 yesterday. And if we have the paper in before the 20th, which we had got in yesterday, we deposit the check in the bank. The first dividend for our client will be the 5th of February. So they don't even have to have it 30 days. If we get the money and all the paperwork done before the 20th, they get their first check in 2 weeks. And they get it for the next 4 years. So this particular fund, they've got 4 years. So unlike the other fund where you get paid every year, you get paid every 4 years if they decide to keep it. Investment secured by tangible real estate. There's no leveraging in this fund. This is a fund. This is not a REIT. This is not a real estate investment trust. It's a fund. Same thing. A fund and a note. You put your money in, you get a promissory note to get 8% a year for the next 4 years. Again, compare that to any annuity that you're marketing. So initial investment, $100,000. The commission is 4.5%. Up to front commission is $4,500. In 4 years, your client renews another commission of $4,500. In 8 years, your client renews another commission of $4,500. In 12 years, if they renew, I know that's stretching it, another $4,500. Total commission in 12 years, 18%. Now, again, you might say, why would somebody buy a 4-year at 8% when they can get a 1 year at 8%? 2 different industries, 2 different programs. And really, I think the magic to what we are doing out there in Silicon Valley is we only give people what they want. We explain how the programs work. We explain the risks associated with the programs. And they make a decision on what lets them sleep at night. Okay, strategy number 3, something called a merchant cash flow fund. Not subject to market risk. Check this out, 9-month program. Double-digit returns. Annualized, the 9-month program is annualized to pay between 12 and 15%. Yes, that's not a typo. 12 to 15%. It's a business cash advance program. And in that particular program, the banks are not lending to small business owners. They lend to the top 10% of all small business owners who need a cash advance. So an example, you have a trucking company. You have 10 trucks. You're going to be delivering merchandise. Your truck breaks down. You need $67,000 for a new truck tomorrow. You don't have the cash flow in right now. You have receivables. You go to the bank. How long is it going to take you to get the $67,000? You call the cash advance program. They advance you the cash in less than 4 hours. So you walk in at 10, and by 2 you're approved, and you got your money by 3, and you go and buy your truck by 5, and now you're going to, that $100,000 of revenue that you were going to lose because you could not deliver the merchandise will come in. The interest rate that is charged, this is not a loan, this is an advance, but the interest rate on this advance is very high, over 30%. And they pay back daily, ACH, the person that actually gets the advance, daily for 9 months. Some are shorter terms than that. And the company's making 50, 60%, and they're paying 12 to 15 to you, the investor. It's a favorite of a lot of our clients. Now, the only thing I don't like about this program is that the commission is really, really low. It's a little over 1%, but every 9 months. So in a 4-year term, you're going to make just as much as you made on the real estate fund, 4.5%. You're just going to make it a little slower, but every year you're going to get a renewal of over 1%. But clients really like this plan. Again, a secondary market product. Strategy 4, where I started. And this was a tough go at the beginning and a tough sell at the beginning. And this is a strategy called life settlements, not subject to market risk. Potential, though, for double-digit returns. But it is the only non-economically driven asset class in the marketplace. This has nothing to do with real estate, land, economics. It has to do with actuaries. And it's kind of like a reverse mortgage of the life insurance industry. It's where people that get older actually sell their life insurance policies for 4 times more than what the net cash value is worth. Warren Buffett owns over 900 million of this. It's healthy, it's legitimate, it's well funded, it's growing. Major banks invest in it. Because why we call it a non-economically driven asset class is that somebody gives you $10,000, $25,000, you can tell them what their return is going to be. The return is guaranteed in the contract. The time that you're going to get the return is not guaranteed because it's based on life insurance policies and people dying. And overall in the industry, when you talk to, in San Jose, when I talk to 100 people, less than 15% of them want to buy this asset class, even though it's a tremendous asset class. That's why the other notes was what made our business explode, because we had the opportunity. Who was going to turn down 8% for 1 year? So anyway, with a fractional life settlement, Mrs. Jones sells a $1 million face value policy to a life settlement company for $250,000 cash. The cash value is about $75,000 if they actually cancel the policy. Here the life settlement company is going to give them $250,000 and the client walks away. So then the life settlement company sells portions to investors, which is down here at the bottom right-hand side. And an annual return is based on the face amount and life expectancy of the plan and their portfolio. So for example, here's an example of a portfolio of someone who has invested $500,000. So as soon as they invest their $500,000, or just before they have their $500,000, they have to sign this illustration. And this shows the yield at maturity. So in this example down below, you notice that there's 5 life insurance policies: American General, Lincoln Benefit, Prudential, AXA. Look at the ages of the individuals. The total payout is 19 million. And if you look at the ages of the individuals, there's 81, 82, 74, 76, and 80. The life expectancy from a life expectancy company and companies, this is the expected time that these folks have to live. So in policy number 1, you'll notice that the life expectancy is 68 months. Lincoln Benefit is 54. Prudential Financial 72. AXA Equitable is 52. And Transamerica Life is 74. And you'll notice that the average life expectancy of the entire portfolio is 64%. Okay. The life expectancy company pays for the premiums, but they also offer a guarantee that's 2 years past the premium for premium reserves. So essentially, these people have a very, very good chance. They got a 50% chance that they will not make it to the life expectancy months that you see on this chart. And they have about a 95% chance that they won't make it to the life expectancy beyond that, which is the one that averages 88 months. Or in the case, life expectancy is 92 months on this 81-year-old. These are people that have got a lot of chronic illnesses, not terminal, chronic. So basically, you'll see that over here to the right, the column that starts with client participation purchase price is $127,467. Out of their $500,000 is in this one policy. The payout ratio, they're getting a contractual guarantee on the right side of 70.75% on that policy. That's not a misprint. They give this company $127,467, and they're going to make 70.75%. They just don't know exactly when they're going to get that. That's the unknown. The person could die early, and they'll make 70.75%. The person could die at 68 months, they'll make 70.75%. If they die at 92 months, they make 70.75%. If they last longer than that, they make 70.75%. They make an average of 65.41% no matter what happens, no matter when they die, when all the policies mature. And there's the yield at maturity, $827,070. Minimum investment here is $15,000 non-qualified, $25,000 qualified. So it's something that some of our clients like to try. Okay, so let's talk about comp. Compensation is pretty high. Initial compensation is 9%. So on a $100,000 transaction, you make $9,000. If the portfolio doubles in 6 years, now it's worth $200,000, and they reinvest, you get paid again. And in 12 years, you get paid again. See, the key thing is, just think about it. Other than the Medicare supplements, if you sell a term life insurance policy, you get paid once. If you sell a universal life policy, you get paid pretty good. But your renewals are very, very small. But you still make a little bit. But in the alternative investments, if you have a client that owns all 4 of the programs we just talked about, you're getting renewal income yearly off of your 8%. You're getting renewal income yearly off of your 9%. You're getting a renewal possibly in 4 years on the EQUAL. You're getting a renewal every 9 months on the merchant's cash flow. And you're getting a renewal on the life settlements. Now, give you an example of our practice. We did $3 million in 1-year notes. We did $2 million in 2-year notes. We did about $500,000 in the 9-month notes, and we did close to $4 million with the EQUALT, or the real estate fund. Did $500,000 in life sales. And when I say life sales, that's target life premium. Selling very, very large ticket items where the average target was no less than $20,000 a case. Those all have renewals. And we're just cranking up our first series of clients, appreciation dinners, and we have confirmed about 200 of these typical, when I say typical, 60 to 70 years old, between worth over $250,000 to $4 million, that I will be speaking to in the next week, starting the 2018 campaign. You probably can understand why I have a tremendous amount of confidence going into this year, and why I'm very excited Hey, thanks for taking time to be on this webinar today. We look forward to building your trust moving forward in the business. I'm going to leave my phone number up here for just a few moments. If those of you want to talk to me at some time in the very near future, I will be very difficult to talk to starting Saturday for the next couple of weeks because, like I said, I'll be presenting in front of 200 people here in the next week in Silicon Valley. You guys can contact Barry. My partner, Greg Talbot, would also be able to help too. And I'd love to talk to each and every one of you. If we get an opportunity, maybe we can at some point in time talk. But here's my direct extension number at my phone number here. And then if you want to unmute everybody, Barry, we can maybe answer some questions.
All right. I was going to even say there might be. I was going to say the other factor of the chat. I just want to add saying that's our problem on unmuting. I want to add to what Ron was saying. If you guys have clients, people that you want to talk to, and you're not familiar with the market, which you're not, call our office. We can get Greg Talbot, us, any of us, to help you make sales and get into it. After you've had a few sales, you're going to see the easiest market to get this in. Are there any questions right away? And if not, we'll get going and on.
She received a card. She's had it for over a year. She obviously doesn't ever get any drugs, but she was calling me about it, and she said, I still don't have a card. So I said,
Hey, we unmuted everybody. So if you're having other conversations, please leave the call. That's the only problem when we unmute. Is there any questions out there?
I think maybe, maybe she's not here anymore. She's got to be, though, because I would have put her the cheapest one. So anyway, what do you want to get from her?
We must not have any questions because
yeah, we'll stop.